Are you looking to earn passive and dependable dividend income in Canada? Check out this list of my top 8 picks for the best Dividend Aristocrat stocks in Canada. Let's start off with what is a Dividend Aristocrat. So a Dividend Aristocrat, it isn't just a funny name. It's actually a special type of dividend stock. So dividends are one of the ways that companies reward their investors. The company pays a part of its profits to its investors based on how much equity or how many shares of the company they own. Not all companies pay dividends, and not all dividend paying companies are the same. Among dividend payers, there are commoners and there are dividend aristocrats. Dividend aristocrat criteria. In Canada, a company that's listed on the TSX and a member of S&P Canada BMI will be considered a dividend aristocrat if it 1. Increases its dividend payout for 5 consecutive years, and also 2. Have a market capitalization of $300 million or more. These requirements are much less strict here in Canada than they are in the US. There, a company must raise its dividends for 25 consecutive years to be considered a dividend aristocrat. When you're looking at buying a dividend aristocrat, yield isn't the only thing you should consider when you're looking into it. There's other things like capital growth prospects, payout ratios, dividend growth rate, and even payout frequency, if you're investing to start earning dividend income, are all important factors to consider. Number 1 pick for me is Fortis stock. Fortis is arguably the most revered dividend aristocrat currently trading on the TSX. It's been increasing its dividend payouts for 46 consecutive years, making it the second oldest aristocrat in Canada, after Canadian Utilities, which is the oldest. Fortis is a smart buy, and not just because of its stellar dividend history. It's a utility stock with a significant presence in Canada, the US, and the Caribbean. It serves over 2.2 million electric and 1.1 million gas utility customers. This offers cash flow and revenue stability to the company because usually in economic downturns or recessions, people prioritize paying their utilities, so it's a very non-elastic demand. 99% of the company's $56 billion worth of assets are regulated. This makes Fortis have an enviable balance sheet. And the company is also focusing on clean energy and renewable sources, which means it's well poised for the future and beyond. Fortis also offers a good dividend yield and a decent dividend growth rate. Between 2016 and 2020, the compound annual growth rate, or the CAGR, of its dividends was almost 5% at 4.78%. Not only that, Fortis offers capital growth. In the last decade, between 2010 and 2020, the company grew by almost 9.6% every year, and that's adjusted for dividends. This might not be as high as some powerful growth stocks, but it's very generous for a stable dividend aristocrat stock. In my opinion, Fortis gets the top stock for more than just its dividend growth history. My number 2 pick is Metro stock. Metro is another old one on this list. With over 25 years of consecutive dividend increases under its belt, this company can pass for an aristocrat even in the US, but it definitely fits the list for Canada. It might seem like a step down from Fortis, especially when you look at the dividend yield, but what it lacks in the size of its payout, it more than makes up for it in 2 areas. Number 1 is dividend growth, and number 2 is capital growth. In the last 5 years, the company grew its dividends by almost 9.4% each year, which is huge. Metro's capital growth history is even more powerful. Its CAGR for the decade between 2010 and 2020 was 17%. This is powerful enough to double your capital in 5 years. If you are preparing a dividend-based investment portfolio, you might want to think twice before discarding Metro for its relatively low yield. It can add a lot of activity to your investment portfolio, and investors with dividend-based portfolios also need to sell stocks sometimes when the dividends are not enough to cover expenses. So growth-oriented aristocrats like Metro can be powerful diversification dividend stocks in these situations. The company is not safe in the same way that Fortis is in terms of its revenue stream, but it has its own strengths. It deals in two things that are prioritized even more than utilities, which are food and health. The supermarket chain has over 950 food stores under different banners and over 650 drugstores. This enormous footprint and its business model makes it an ideal long-term investment. My number 3 pick, and you'll probably recognize this one, is Enbridge. I feel it would be disrespectful to create a Dividend Aristocrat list without Enbridge. It's one of the largest energy companies in Canada and a leader in its sector. The company is responsible for moving 1/4 of the oil produced in North America through its extensive pipeline networks. It also transports 1/5 of the natural gas used in the US, which is huge. It's also focusing on renewable energy and has stakes in 21 wind farms, with a combined capacity of 3.9 gigawatts. And it's exploring other options. The company has always been generous with its dividends and hasn't slashed them despite economic hardships. It sustained its juicy yield and generous payouts even through the 2008 recessions, during the oil price plunge between 2014 and 2016, and even in the earlier 2020 market crash this year, oil demand pushed the prices into negative territories, and even then, when the payout ratio grew dangerously high, the company's commitment to sustain its dividends makes it worthy of this list. Not to mention its very generous yield that can be game-changing in any dividend-based portfolio. Thanks to a wealth of assets, the company has a solid balance sheet. It's well-positioned in the North American energy sector, but it doesn't offer a lot of capital growth potential, is my opinion. My number 4 pick is Canadian National Railway stock. Canadian National Railway is a North American transportation giant that owns and operates a 20,000-mile network in Canada and mid-America. The bulk of its revenue is generated by its logistics operation. CNR's railroads connect 3 coasts: the Atlantic, the Pacific, and the Gulf of Mexico, which puts it at an ideal place from a logistic and heavy cargo transportation perspective. The company has a rich and eventful history of stitching together different parts of the country together. Such companies manage to garner a lot of positive investor sentiment since they are part of the country's history. But CNR seems like a solid investment from a pure numbers perspective as well. Its assets are almost 1.7 times more than its liabilities, making it a trustworthy asset-backed company. Another benefit that it enjoys is a state of very little competition. As a dividend stock, it mimics the pattern of Metro. The yield is not very mouth-watering or very high, but its capital growth is. In the last decade, it almost grew 17% every year based on its 10-year CAGR. It also grew its dividend by almost 9% a year between 2016 and 2020. It's usually a bit overpriced, so a good time to buy it would be during a market crash or a recession when the stock is a bit more fairly valued. A number 5 pick is Telus, which you probably have heard of. Like our banking system, Canada's telecom sector is operating almost like an oligopoly, with 3 telecom giants controlling over 90% of the market share. One of the big 3 is Telus, an aristocrat with 16 years of dividend increases under its belt. This telecom giant covers a wide spectrum of services and products, including voice calls, internet, IPTV, entertainment, and more. The company had over 10.2 million wireless subscribers, 2 million internet subscribers, and 1.2 million TV subscribers in 2019. The future growth of the company, along with the other 2 telecom giants, depends upon successful 5G deployment and government regulations, which are trying to curtail the power that comes with an almost no competition environment. The company offers a juicy enough dividend yield, but that's not what sets it apart from its other more sizable peers. The company offers pretty decent capital growth potential also. Its 10-year CAGR comes out to around 12.7%, and that's dividend adjusted. The balance sheet of the company is strong enough. And overall, Telus offers a pretty decent combination of growth and dividend yield, especially if you buy it when you feel it's fairly or undervalued. Number 6, National Bank of Canada stock. One of the most common ways of introducing the National Bank of Canada is that it's not one of the big five banks in Canada. But it's important enough that the term is sometimes stretched to include this powerful financial institution and renamed to the Big Six. It offers a high yield usually, which becomes even more mouthwatering if you buy it during or right after a market crash, when the valuation is substantially down. Even though it usually offers a sustainable and high yield, especially for a decade-old aristocrat, a better reason to buy this bank would be its growth potential for both capital and dividends. It grew at a rate of about 12% every year over the last decade, which is very powerful if you consider the steadiness of the Canadian banking sector. It has an impressive footprint with over 422 banks in Canada, 207 million clients, and about $565 billion worth of assets under management. The only chink in this bank's armor that I see is its international reach, which is focused primarily on Cambodia, which is very well susceptible to local headwinds, and it's not even considered an emerging market yet. Number 7 is Toronto Dominion or TD stock. Since we're on the topics of banks, let's talk about TD. TD is one of the big five banks in Canada. It's the second largest bank in the country, the fifth largest by the number of branches, and the sixth largest by total assets in North America. It serves over 26 million customers around the globe with 2,300 active locations. It's also one of the most American banks in Canada with a huge presence across the border. TD has a very long dividend history. The bank has been paying dividends to its investors for over 160 years. Most recently, the bank has increased its dividends for 9 consecutive years. It has a balanced balance sheet and with over $1.4 trillion in total assets. Its dividend history and sustainability of its dividends is almost similar to the top dog in Canada, which is Royal Bank of Canada or RBC. But TD beats it out for its recent capital growth pace. The bank also has an edge when it comes to active digital customers with over 13 million. That's the next domain of operations, and less dependency on brick and mortar branches should result in less operating costs and higher profit margins. Number 8 is the Exchange Income Fund. Like TD, the Exchange Income Fund also has a 9-year dividend growth streak, but it offers a more powerful yield and better capital growth prospects in my opinion. It's the smallest stock on this list of 10 stocks by both market cap and assets. EIF is an acquisition-oriented company that primarily focuses on aviation and aerospace companies. The company has created a diversified portfolio of underlying assets, from material and manufacturing companies to sales company and a flight college. It has accumulated an extensive range of companies and entities associated with the airlines industry. This, though, is one of the reasons why the company suffered a huge blow in 2020, along with airlines around the globe. Despite suffering a major dip in both stock valuation and profits, the company didn't slash its dividends, so it kept it relatively high. Apart from offering one of the highest yields on this list, the company also offers a pretty decent chance of capital growth. Its 10-year CAGR, or dividend adjusted, is over 14%. Which is huge. So there's lots of ways that you could buy Dividend Aristocrat stocks in Canada. My favorite way is to use a discount brokerage because it's usually the cheapest way to do it, and I like to use Questrade. If you're interested in it, I put a link in the description for $50 in free stock trades, so make sure you check it out in the description. Alright guys, if you liked and enjoyed the video, make sure you like and subscribe to the channel. I'll be putting out new content every single week. And also, make sure you check out the wealthawesome.com blog. I go into this topic in way more detail. I expand on this list from my top 8 picks to the top 10 picks, and I also go over way more subjects just in regards to things like ETF trades and personal finance for Canadians. So make sure you check it out. It's wealthawesome.com, and as always, thanks for listening.